Hello traders, my name is Olajire Awofisibe. I am the managing partner for Finspot Academy. Today, I want to help traders demystify the problem of trade setup. So in this particular video, I'm going to be sharing with you the process of setting up my trade. So today, I will probably just focus on my sell setup, and in subsequent video, I'll be talking about how I do my buy setup. This video is going to be, slightly longer, but I'm going to take my time to break things down into smaller pieces. And I would like you to follow me as I, break this down. Now, before I continue, let me tell you this. Before I started becoming a profitable trader, I have lost quite a lot of money, and I jumped into trade without taking my time, to actually analyze the market. Please don't get it wrong. I actually paid to learn how to trade, and it took me over a year to actually learn how to trade in the Forex market. All right. However, one major challenge that I have is I used to just enter trade without taking my time, without applying some of the things that I've been taught in terms of trading psychology and quite a number of other things that could help me become a successful trader. And I got my fingers burnt in the market. All right. It took me a while to learn a lot of lessons. Right. I lost so much in trading, and one thing that stood me out in the end was my, desire to learn. And I kept learning new things. Every time I make a mistake, I try to, stay away from trading and learn new things and understand why I've been failing. And today I am a very, 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 very profitable trader. So in this video, I'm going to be sharing with you what I do, before entering a trade. Number one, I do not jump into a trade, until I have finished doing my analysis. Number two, I take my time to actually look at the direction from a top-down analysis, and from that point, I'm able to understand where the overall direction of the market is, determine where price is going to eventually go to or get to, and then, go to lower time frame. And sometime, if I want to, I'll do a counter trade, to my point of interest. And I will now, take the trade that is meant to be in the direction of the market. So in this particular video, I'm going to be using Ethereum, and I particularly decided to use Ethereum, for this particular video, because number one, is a cryptocurrency. Number two, it is actually a volatile asset. Number three, I want to show you that it doesn't matter how volatile an asset is. If you know what you are doing in the Forex market, you are actually going to be able to navigate your way and make profitable trades. So without much ado, I have tried to, bring up some, processes here from 1 to 12, so that we'll take it one after the other. And I would like you to follow me as I, journey with you in this video, or as you journey with me also in this video. So I have titled this particular video Trade Setup Process, and this is the sell version. So I'm going to come up with the buy version. So let's take our time to take each of these points one after the other, and let's see how to navigate the market and get a good sell. All right. Now, let's assume that I get into the market, on this particular day, and this is what I am seeing. The first thing I would do, according to number one here, is to determine market structure. The first thing I can see here is that market is in an uptrend overall, and I'm sure you can understand what I'm talking about. Now, after determining the structure of the market, the next thing I want to do is to draw my trend line, in line with the current market structure. That's number two. So we are number two now. So to draw my trend line, I'm going to take my trend line from my 2 bar, and I'm going to draw a trend line. And one thing I wanted to take particular attention to in this particular video and how I'm drawing my trend line is that I am taking my trend line from the last swing low that I saw here, and I'm, carefully trying to check that at least the first 3 candles are not closing below the trend line. So the first one I'm seeing here is this particular rejection candle that I see, this black candle that I see here, that's a bearish candle based on my own setup. So I drew this trend line, and this is what I am getting. All right. Now, why am I saying this is a valid trend line? It is a valid trend line because it's touching at least 3 points up onto the current, market price. All right. Or up onto the current price action. So this gives me the confidence that, this is a valid trend line. So that takes care of number 2. Number 3, identify current price action and look out for shifts in market structure. Now, the current price action here is that if you look at this particular chart, you will see that the highest point after the takeoff from here, the highest point price could ever get to is this green line, or let me mark this red, to distinguish it from being a support line. So my support, is actually this green line at 1374, and my resistance is at 2136. All right. Now, what this is telling me is that after this takeoff, right, price could not break this horizontal resistance here. And the highest point that price got to before, finding difficult to break is at 2136. Now, if I get to the market, the first thing I am going to be seeing here is that price is finding difficulty breaking, this resistance. However, is this a license for me to start trading these markets? The answer is no. Now, what a lot of us traders will do is when we see, somebody will say, I have seen multiple rejection, so it's a sell. So the next thing you do is to jump into the market and start to sell. Now, let me tell you why that is risky. It is possible for price, to just keep going up. And let me also show you something before that. If you look at this particular current price action, every time price get to the trend line, from the point it started from this support line, every time price gets to this, trend line, it bounces off. I mean, as you can see here and here and here and here, this is a very strong bullish movement. However, the buyer seems to be getting tired when they got to this particular point. This is giving me an indication that, there might be change in market structure anytime soon. However, I don't have a confirmation yet. A confirmation for me will be that price would break the trend line with a bodily closure on the daily, and then come back to look for an institutional reference point, such as order block, fair value gap, mitigation block, breaker block, and all sorts, of institutional references, to then sell back to the starting point. Okay. Another thing I need you to take particular note of is that as price is trying to uptrend, price was actually leaving some footprints for liquidity to be grabbed in the future. This is what I mean. Now, if you look at this, there is liquidity sitting here, there is liquidity sitting here, there is liquidity sitting here, there is liquidity, also sitting here, as you can see, right? And this is the final liquidity that has been created. Now, what am I saying? As price is going up, is always coming back to leave some spike that it may come back to sweep as soon as market start to change direction. Now, how do you know that this market is going to change direction, the first thing you have to take particular note of, if you are focused on the daily, is that this low, right? This is the higher low, the last higher low that was created, let me just quickly show you something here for those of you who probably do not understand market structure. Now, market structure is all about, looking at the direction of the market at any particular point in time. And for me to explain this, let me tell you that market only moves in three ways. It's either the market is moving upward, or is moving downward, or price is actually consolidating. Now, I'm not going to focus on a consolidating market. I don't actually trade a market that is consolidating. I like to see clear breakout either to the upside or to the downside before determining my trade or taking my trade decision, right? So having known that price moves in three major directions, what I will be focusing on, like I said, is an uptrend, and watching out for when that uptrend is likely to change direction for the upside. And to demonstrate that, I will probably just use this to show you something about how price move in the market. So if it's an uptrend, the first thing you will see that you will see this kind of price action. Price will go up, create a high, break structure, right, and come back to the previous low, right, and then break that structure, continue to come down again, break structure, until price gets to a point where you start to see things like price not being able to move with the same momentum, and all of a sudden you see that the previous low gets taken out. What do I mean by previous low? Now, those of you that understand this theory of market structure, they will tell you that when you start to see series of higher high and higher lows, it means that the market is in an uptrend. And when you start to see series of lower lows and lower highs, it means that the market is in a downtrend. Now, what I am actually taking this particular training on this video is to show you how you can actually identify whenever there is a shift in market structure. Now, what do I mean by a shift in market structure? Now, this is where the market started from. Created this high, came back, but could not get back to the previous area where it started from, and then went up again, then broke the initial high. This is what people call break of structure. So there is a break of structure here. It came back. What you will see is that price usually come to an institutional reference point, right? Which could be an order block. In this case of an uptrend, it's a bullish order block, most likely. And there is also another reference point that you can use, which is actually a fair value gap that can be created. Now, I may not be able to have all the time to start explaining. Let me just remove this setup and just remove this 0.25 and this 0.75 just to ensure that my chart is not too clustered so you can actually understand what I'm trying to explain. Now, for me personally, I like to use green to describe my bullish order block. Now, don't worry. Like I said earlier, if you want to continue to get notification whenever I share a new video, on this channel, please make sure you press the like button and subscribe to this channel. But one thing I can guarantee you is that you are going to learn a whole lot of things on this channel that is going to change your, trading life and ultimately improve your patience. Now, look at this. I want to make this one green so that I can differentiates a bullish order block from a bearish order block. Don't bother about all these terminologies if you don't understand it yet, but just follow my explanation. I'll try my best to explain to you. Now, I said when you see price, now what you see here is that you find out that there is a break of structure right here, meaning that price breaking the previous high, right? After noticing a break of structure, please let me save this actually as break of structure so that each time I need it, I will always come back to it as a template, right? So when you notice, what you will notice here is that you notice a break of structure and price actually gets into this high. This high here is called a higher high. This high here is called a higher high. Let me just, describe it as a higher high. So you see a higher high here. All right. So I'm just trying to explain the theory of what I'm about to explain so that by the time I go to the main chart, go back to the main chart, things will start to make sense to you. So what I'm just trying to say here is that you will see that a new high will be created as soon as there is a break of structure. You see what people call higher high. A lot of traders call it higher high. But mind you, the market is not picture perfect. So you really need to train your eyes to be able to identify the higher highs, the break of structure, the shift in market structure, and all that, because it will not be that perfect when you get to the real life market. All right. So I'm also trying to show you the high here. So there is also a low, all right? So you see a low, and that low was created when this move started from here. So you see a low, you see a high, then the next thing that you will then see is a higher low. Why is this called a higher low? This is called a higher low simply because when you look at this low that actually started at this point, that started at this point, you see a high and the market tried to create a low, but that low is not as low as the low here, that is the previous low. That is why we call it a higher low. For those of you who may not understand the difference, this is a higher low. And after this, another higher high was created. Why is this place higher high? It is higher high because when this break of structure came up to this point, price could not get to this point, to this previous, price could not get to the previous higher low and went back again, look for an institutional reference point to actually go to the upside. So this is a higher high because this higher high is higher than this high, and this is a higher low because the higher low is higher than the previous low. And then just like that, you start seeing market painting series of higher lows and higher high. So this is higher low, this is higher low, this is higher low. Now, look at something here. Immediately this higher low was created, another higher high and higher low was created. All right. Now, one thing that you need to observe here is that if you look at the momentum at which the price was going up here, price did not go up at the same pace at which it moved from here to here, right? And created another low and tried to go above the previous higher high, but could not make it, right? And tried to come to the previous higher, but created a higher low here somehow, all right? So another higher low was actually sorry, pardon me for this. Another higher low was actually created at this point. Why? Because this low is still slightly higher than this other low, and then went ahead and created a higher high. Now, watch something. If you look at the pace at which market was moving from here to here to here to here to here, you cannot compare the movement to what happened here. It means that the buyers may be getting exhausted. And look at what happened. After that higher low was created, higher high was created, price came all the way to take out the last two higher lows that were created. And you can see a strong momentum here. This is an indication. It doesn't have to get to that point. This is an indication that, price is about to go down. Now, another thing I would like you to note when you get to the market is once you see something like this, just come here, draw a trend line that connects all your higher lows and all your higher highs, and check by yourself if price is about to change direction. Now, what you can see here, because this candle most of the time is going to be a very strong bearish candle that closes below the trend line, right? With the body, mark my words, with the body, not the spike or the wick of the candle. If it closes, if it spikes down, it is not a shift in market structure. You need to understand that. Now, immediately you get into the market and you see a shift in market structure, that is the previous high that was created has been taken out completely. That's number one. Number two is that there is a closure below the trend line. What this is simply telling you is that if you are thinking of buying, you need to find a way to change your mind and see what the market is about to do. Now, most of the time, what you will see is that if you look at this break, a lot of time people will hear, oh, wait for confirmation, wait for confirmation. But when you see price moving in another direction, you just jump into the market and then you make yourself a liquidity for the market. No, you don't have to do that. For you to be a profitable trader, you need to have enough patience to wait to see what the market is about to do before you actually jump into the market. It is very, 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 very important. And the second thing that you need to do is to find a way to understand the rhythm of the market. And what I'm trying to explain to you in this particular video is the rhythm of the market. I'm just showing you how the algorithm that, make the market to move in the way the market move based on the forces of supply and demand, how the rhythm of the market actually looks like, okay? And how, buyers and, sellers in the market actually look at the market and take their decision, all right? Another thing you need to understand is that you can know all of these things and then you are still afraid to execute, right? That is simply because you have already done your analysis. Your analysis is telling you that you're supposed to sell, but because you see someone that you probably trust, it could even be your mentor. It doesn't matter because you do not know what is in the mind of the mentor, right? Just trust your own analysis. Define your own rules. Ensure that all the things in your checklist of, your trade setup are ticked off before you enter. Once you do that, manage your risk. Now, let me continue with this particular video. Remember, today, I'm only going to be focusing on a sell setup, right? So now, one thing that is important for you to note here is that there is a confirmation for a sell, there is already a sell confirmation as far as I am concerned. Now that I've seen a sell confirmation, the next thing I will be looking out for is some institutional reference point above this closure. What a lot of people would do is just to enter a sell trade. I will not enter a sell trade because if I look above the closure, irrespective of the time frame that I'm using, I will see some smart money, reference point or smart money concept that I can use to actually take a sell trade. Right now, I know what I should be looking out for is a sell trade and not a buy trade. Why? Because I have seen confirmation at this particular point here that the market is about to change direction, and that is what we call the shift in market structure. That is what we call a shift in market structure, or what some people we call church, which is, change of character. All right. So that has been identified. And for that purpose, the next thing I'll be looking out for is to look out for the bearish order block one that led to that strong sell. So if you look at the market, you will see, if you look very closely, you will see that there must have been a bearish order block. For those of you who don't understand the terminologies that I'm using, please stay tuned to the channel, and you will get a new video where I'll be breaking down, some of these terminologies. I'm going to be talking about, 5 to 6 very important, institutional reference points that you need to pay attention to. And I, as a person, it was when I started trading behind the big boys in the market. I'm talking about the institutions here. Please pardon the use of my words. I mean, the use of my language or whatever. What I'm just trying to say here is that I know that the people that move the market are not really the retail traders. So as a retail trader myself, what I do is to follow the institution. And how do I follow the institution? Is to learn what they look out for and their footprint in the market. So when you come to the market, you are likely to see an order block here, one, or you are likely to see, right, a fair value gap. Now, this is where entry gets very tricky for some of us, all right? It gets very tricky because sometimes you see an order block and then you see a fair value gap, all right? And then you are confused about, which one you want to use, all right? For me as a trader, I always, place preference on fair value gap, before the order block, because over the years that I've been studying the market, this is what I usually see. When you see a closure like this, right, and you see a very strong bearish engulfing candle that closed below a trend line, and not with a spike, all right, this is what you are likely to see. Price don't move in a straight line. Then you then see price moving like this in lower time frame, trying to get back towards the point of interest. So those two areas are likely to be my point of interest. But the first area I'm going to be paying attention to is the edge of the order block, of the fair value gap. And then you can see price test this area, come down a bit, show another shift in market structure, and then come to the consequent encroachment area before heading towards your point of interest where, the buyers may be residing. You need to understand the rhythm of the market. Now, this is also a point of interest. So if you are afraid that price might take you out, you might actually drill down into smaller time frame, and you might see that price sometimes might get to this order block that was created at this point, right, before actually going down. So the middle of the order block, the edge of the fair value gap, the middle of the fair value gap, which I call the consequent, that's the middle of it, which is the balance, that is the area of equilibrium, which I call the consequent encroachment. Let me just put it there so that you can see what I'm talking about. This is consequent encroachment area. I think I have that in my template. I don't think I do. So that's the consequent encroachment area. So let me just put it down here. It's called the consequent encroachment area. Consequent encroachment area. Consequent. It's called the consequent encroachment. That's the middle of the fair value gap. Now, this is what you see now. Another thing I need you to understand is that as soon as there is a shift in market structure, price will begin to look out to sweep liquidity, that has been created. So it will come for this, it will come for that, come for this also, come for this until it takes out the last, liquidity at this point. So buyers may be residing here to take the market upward. But right now, what you want to do is to actually sell this market. But once you see price get to your point of interest, you can actually take a buy trade, taking your TP, back to, the premium area. I'm going to talk about premium and discount in the course of my explanation of my trade setup. So guys, this is just to quickly explain to you how the market moves and what you need to look out for and how you need to determine your entry. Just to summarize everything that you're seeing here, what I'm seeing here is that as soon as you see some level of exhaustion in the market, you can actually look out for some institutional reference point that you can use to take the market back to where it started from. So by the time market is going to come down, it's going to probably just come back to be looking for liquidity. So all these areas that I marked, here are actually areas of liquidity where money resides. So money is residing here, money is residing here, money is residing here, money is residing here as well. All right. And this is the final liquidity that was created. Until you see that there is no other support for price, and you see price, trying to change direction, and you see price trying to change direction, right? This is the last liquidity that you will see. However, always watch out, because let's say, for instance, I have taken my TP, liquidity has been swept here, liquidity has been swept at this point, liquidity has been swept at this point, and price didn't necessarily get to this area. And all of a sudden, you see price start doing something like this, retracing backward, and then there is a closure above. Do not continue to look for a sell, because right now, price has taken out the previous high. So the next thing that is likely to happen is for price to look for other institutional reference point here and then continue the move, to the upside. Please do not make yourself liquidity for the market. So I have tried to explain the theory of what I'm trying to explain here. So let's go back to the chart and see how that is demonstrated. So I've determined the current market structure. I have drawn my trend line. I have identified the current price action, and I'm now going to be looking out for, shift in market structure. So how do I look for that shift in market structure? It might be difficult. Now, for instance, I'm going to be very careful taking myself from here because I have not seen price, come back to the trend line, because anything can happen. Price can actually get back to that trend line and then, move back to the upside. So you don't want to take a risk if you are using the daily time frame as, your base for watching out what the market is likely going to do. So for the purpose of this video, I am only going to be focusing on the current price action. But how do I then determine whether price has changed structure or is going to change structure or not. Now, because I have seen this assertion rather, please guys, pardon me, because I've seen this assertion in the market, the next thing I want to do is to drop down to a lower time frame and watch the market until I see a shift in market structure, maybe faster than what I can see on the daily in the lower time frame. So the next thing I'm going to be doing, but before doing that, right, let me just quickly tell you what I would do. I would pick my Fibonacci tool, which is here. I will take it for the previous low. Let me just take this out so that I can see the previous low. I will take it from, let me take this out as well, so I don't get my chart clustered, right? So I will take it from the previous low. I will look at it from there. I will take it from the previous swing low, and I will take it to the swing high. Now, what is this telling you? This is just telling you that price started from here and started getting exhausted from here on the daily. This is just a sign or an indication that anything can happen. Anything can happen in the sense that price can eventually consolidate here and then do something like this, close above, and then come back to somewhere around this place and look for institutional reference point to start going up. So you do not want to be a liquidity for the market. However, whenever I'm doing something like this, I have a standard rule. Now, when you look at what I am trying to explain here, once you see signs of possible shift in market structure, use your Fibonacci tool to mark the most recent swing low to the most recent swing high in the case of an uptrend, and vice versa in the case of a downtrend. But don't forget, we're actually looking at an uptrend here, and we are looking for a shift in the direction of the market towards the downside, in the market. So, and I said the middle of the Fibonacci is actually called, equilibrium. So this 50% zone is actually the equilibrium. I'm referring to this area, all right? So that is the equilibrium. Now, the next thing I want you to understand here, if we go back to our list, now talking about number 5, if we go back to our list, what you will see here is that I said above the equilibrium point is a discount zone. Sorry, is a premium zone. Please pardon me, let me correct this. Above the equilibrium area is the, let me just correct this very quickly, is the premium. Sorry, this is not discount. Guys, pardon me. This is the premium zone, while below the equilibrium is the discount zone. Okay? Now, what am I saying? I'm saying that this whole area here is premium. I think I have it in my template. This whole area here is premium. This whole area from this 50% upward is premium. And then this point to this other point here is actually, I also think I have that in my template, is actually discount. So this is a discount zone, right? So now a standard rule, the simple rule is to buy from discount and sell from premium. Now, let me just see if I can try my best to explain what buying from premium and selling, sorry, what buying from discount and selling from premium is. So let's assume that you are a seller and you sell Apple. Please just take me for whatever I am. I'm not a good artist. So let's say this is Apple. And let us assume that you are buying this Apple for $100, just for argument's sake. All right? Your intention when you are buying this Apple is actually to sell this Apple and make money. You will definitely not make this money from the sale of this Apple if you are selling at a price lower than this. Now, something actually informed your decision to buy the Apple for 100 naira, probably because you know that may be scarcity of Apple, and then Apple may be selling for, let's say, $150, right? So you want to buy Apple today and take a risk, to wait for another, let's say, 2 to 3 days when Apple become 150, so that you can sell. So at the point the Apple you are buying at $100 is, your entry point, right? At the point of buying that Apple for $100, it doesn't mean that the Apple will not go down and start to sell for less than $100. So this is where the concept of risk management also comes in. Risk management, right? You do not want to lose all your capital, but you are taking a risk. I always tell my students, that there is no gain without pain. So you have to take that risk. But what is important for you is to actually, take calculated risk. So let's say that, Apple can come to $10, it can come to, let's say, $50, it can come to, let's say, $70, it can come to $90, it can come to, and of course, you actually bought the Apple for 100 and you expect it to get to, let's say, 150, okay, which is not a bad idea at all. So you have entered, a contract here. You have actually bought your Apple here for $100 and you're hoping to sell at $150, which is your final destination. This actually is your TP because you want to sell at, now if you look at where you bought the Apple 100 and where you want to sell is above your entry point. So you want to sell at a premium, right? And look at something. I'm just describing this. Look at where 50% area is. Let's say this $50 is half of $100, for instance. Already buying this Apple at $100 is kind of very risky because you are buying at a premium. You don't buy at a premium. So price is likely to get to the discount area, right, before actually coming back, to the premium area. So the patience for you to wait for Apple to get to the discount area, probably you now have the opportunity to buy for $20 and then now wait for price to keep fluctuating until it gets to 150. This is actually what makes you a profitable trader. Now, why a lot of traders lose money is that they will see price of Apple actually going up and probably just coming down and creating some kind of change of character. The moment they see the change of character, the ideal thing is for you to come back, below the change of character and look for institutional reference points that you can actually use to buy. All right. But the point is that if you are seeing any such sign in the premium area, any change of character in the premium area is what we call inducement in the market. It is called inducement. This is where a lot of traders usually have problem. For me, whenever I'm trading, let me go back to my chart and just explain that, right? I'm sure this example of Apple has given you some insight into what is premium and what is discount, Now, what I was trying to explain there is that, what you guys have been taught is that when you see price consolidating in a particular area, they see price going like this and all that, and at the moment you see a shift in market structure, let's say you see a shift in market structure like this is a signal that price is likely to continue to go up. All right. Then you are now advised to come to this area and look for institutional reference points, such as bullish order block, and then you can take your trade from there. All right. Now, and then you can take your trade, probably to your TP, and then you can win the trade. Now, let me show you something here. If what I've just described is happening in this premium zone, you are actually taking a big risk. But if what you are doing, we are seeing here, you are seeing some sort of consolidation here, price is doing this, is trying to go, it comes to this place, it's not able to go, and you see something like this, and you suddenly see a shift in market structure at this particular point here. Let's say here, I would like to actually take this as my own shift in market structure so that I can be so convinced that market is about. So if I see this here, and then I can come to anywhere around here, all right, and look for my institutional reference point, such as fair value gap, all right, such as fair value gap or order block. Let me start with an order block. So this order block, or I look for a fair value gap, slightly above the order block, I can then come back and take my trade setup around this area, which is what I'm going to be describing, here for a sell setup. And, I would like you to really, really pay attention to this, because trust me, guys, if you do what I'm telling you, is going to definitely change your, now, if I come to the market and I've done my setup like this, and I see this happening around here, and I see, this happening around here, I will not pay attention to it. I don't care. Even if the market wants to leave me, let it leave me and go. I would definitely look for another opportunity, either on the same pair or on another pair, that will give me some level of confidence that is a good place to take a trade. However, if what I'm describing happens here in the discount area and I'm looking for a buy, this is the best place to look for a buy. All right. So this is not a good way of taking a buy trade in a premium area. And I hope that you understand this very, very well. If you can understand the concept of premium and discount that I'm trying to explain to you, and you get, or you train your mind to have enough patience to wait for the market to give you what you want to see, before taking a trade. I would never take a buy trade from a premium zone, according to my own rule. Everybody has his or her own rule. So stick to your rule, but I would never take a buy trade from a premium zone whenever I've identified a starting point and an exhaustion point, and I've marked, used my Fibonacci to mark the areas I want to demarcate, so that I can see where the premium area is and I can see my trend line here. I would never take a buy trade from a premium zone. So guys, that is what I need to caution you about, right? And guys, you can go to any pair, pick any pair randomly, and try whatever it is that I'm teaching you right now, and see that it will always play out. At least 90 or 80 to 90% of the time, you will always see something like this, especially when there are no volatility in the market, and it's strictly based on technical. But let me also mention that a number of times, more than 90% or 95% of the time, fundamentals are already built into technicals. The only thing is that the fundamental can actually let your trade activate in the right direction much faster when there is volatility. Your job is to do your proper analysis, do your trade setup, manage your risk, buy from buy from discount and sell from premium. And if price doesn't give you what you want to see, please stay away from the market. Now, what some people will also do, like what I was describing even on the daily, is to look at this area, which is not a bad idea, is to look at this area and see, oh, this is the last bullish order block that painted. and they will use that as an entry trigger or entry point for their buy trade. I would never do that. However, it depends on what you are looking at. You can actually buy from here, but you also have, this is a daily time frame. You also have to go to a lower time frame and check out, look out for this same process, within this particular zone, and you are likely to win the trade. But the only difference is that you might never see price go up above this zone, until price gets to the discount area. So depending on, if you are looking for a short buy, you can actually, try, to do it from here. But you have to do your analysis in a lower time frame. So please do not get me wrong. You can still buy from, a premium area in higher time frame, but a discount in a lower time frame. And that's the point I'm trying to make. So by the time you go to, let's say, 1 hour or 30 minutes, this whole area, you can see the same price action that we're seeing, but you can still determine the premium. And so this is a daily chart. This same picture, you can see it in the 1 hour chart, you can see it in the 30-minute chart. So depending on the time frame you are using, guys, it is still the same, bro. It is just that what is premium and discount, right? Or what is premium in higher time frame can be discount in a lower time frame. So please understand that. So don't get confused when I say that. So I'm not referring to the higher time frame alone. You can always go back to the lower time frame and actually look for the same price action and use the same trade setup. I am only using this daily time frame to describe what I'm trying to do. If you go to a weekly, it might be a totally different, ball game. A discount area, a premium area for a higher time frame might actually be, the discount area, in a lower time. It depends on, whatever it is that you are looking at. So for me, I am actually doing a top-down analysis from a daily to the lower time frame to determine the point of entry for myself. But one thing I will not do is to start selling from here until I see this trend line broken. So to convince myself that this price may be about to sell, I may want to go to a lower time frame to watch out for when that trend line is going to get broken, so that I can catch it faster, because it will happen in a lower time frame before it happens in a higher time frame. So I can then use the lower time frame to determine my entry. So the next thing I will do is to go down to 4 hours. So let's go to 4 hours, guys. Now look at, in 4 hours, I am not seeing any break of the trend line, and the market is still a bit choppy, right? So I would like to stay away from this kind of market until I see a sudden closure, below the trend line, or below anywhere here. All right. Once I see a closure below here, especially, I'm actually watching out for a closure below the trend line. That's what is even important to me. But I want to catch it first, faster, because it can be a spike on the daily time frame, but this one may have been closed. I might have seen a closure on a lower time frame. So I'm going to wait in lower time frame here and see when the 4 hour is going to break. So I'm going to play forward, right, to see. Now let's see what happens. Okay, I'm watching, and now I got it. Now I got it. Now I got it. Now, guys, let me play this back and show you what I am looking at in this area. Let's go back to that particular area. This is the very first time. I'm going to just cut this. This is the very first candle that actually closed below that area that I'm going to be paying. I mean, the very first shift in market structure that I'm actually going to be paying attention to, which is this guy here. All right. So I'm shifting this backward a little so that you can understand what I'm saying. Now, yes, I have seen a bounce of the trend line here. But one thing is certain here. This is a very strong, if I go to my a lower time frame, you'll probably see that this thing that is looking like a very strong bearish momentum in 4 hours, could have happened earlier in lower time frame. But because of time, let's just focus on this time frame. So in this time frame now, if I go back to my lists, right? What am I looking for? I'm looking for shift in market structure. And the first shift in market structure, or the first time I've seen a shift in market structure, is when this liquidity got taken out. You can see price actually closed below here, which is a very good confirmation for me, which I'm getting in a 4-hour time frame. So the next thing I want to do is to go to lower time frame and see if I can get, or the next thing I may want to do first is to play this forward by a day, and see if I am going to see the next candle. If I see the next candle that closes right after this, if I see the next candle that is closing after this, if I see it, then it makes life easier for me. But I can actually go to lower time frame first before even going to see the next candle that actually, closed, before this. I can see how this, this large candle painted. So I want to go to, let's say, 1 hour to see. Now, in 1 hour, I've seen a closure below, right? I've seen a closure. Those guys, watch this. Please pay attention to what I'm saying. It's going to change. I saw a spike below the trend line, all right? It can be a body in much lower. It can even go to as low as 1 minute, but let's make it very simple. Here now, I'm looking for a sell. The first thing I can see here is this is the immediate order block. That is the immediate order block that I'm seeing. So I am going to be marking out the order block for you to see. It's a tiny order block here, which I'm actually going to use a red color to let you see very clearly. This is red. So this is an order block. What this one is telling me is that there is tendency of price coming to this. But the next thing I want to then see is to see if I can get, if I can get a fair value gap, right? So the first fair value gap I can get is between here. Fair value gap is a 3-candle price action, where you try to connect, when you see imbalance, and you try to connect the high of the first candle here to the low of the first candle. This blue candle is the low, that's the low, and then the high of the third candle, which is this particular candle. So here, what I am seeing is that the middle of this point here is called the consequent encroachment area. However, I have seen a break of this area, right? I've seen a break and a retest, but that retest is not convincing enough. However, I've seen a closure above that area. So the next thing I'm going to be doing is to make this particular area, or I can actually join a trade, because number one, I can actually join a trade, a sell trade from this particular area, and I'm going to take my stop loss slightly above the consequent encroachment area, because if price breaks the consequent encroachment area, definitely this is going to be a bad trade for me. So what I'm going to do is to say, okay, let me even take my trade from here. All right. Let me also now put a signal to short this here immediately because I've seen this. I can go to lower time frame if I want. I'll put my stop loss slightly above here and then go back to the daily candle or the daily chart. Now, in the daily chart, what am I going to be looking out for? I'm going to be looking out for the liquidity that has not been, and you can see coming back to the daily, very interesting. After checking from the lower time frame, you can see that now the daily candle has actually closed below the previous, the trend line. So now, what am I going to be looking out for? I'm going to be looking out for the area of liquidity, below the trend line. All right. I'll be looking out for the area of liquidity below the trend line. So any liquidity that has not been taken out, in the higher time frame and below the trend line is a target for me to take profit. So I'll be looking out to take profit from here because I know that liquidity is resting on this place. I will also be looking out to take profit from here just because I know that liquidity is resting in this zone. Watch carefully, guys, what I'm doing. I am not putting my TP. I am not putting my TP below. I just want to assure myself that I would have taken profit before the sweep of liquidity just to avoid being any form of reversal. And then I'll be taking out, I'll be looking at the next liquidity, and in order not to be greedy, I'll probably just see whether I'll be able to take out profit from this zone. I'll come back to this liquidity later because I know that price is likely to want to do some level of retracement before coming back to this area. And the next thing I want to do is to extend this, and then I'll bring this back to where I want to take my profit. Now, one thing here is that if you look at what is going on here, you will see that the risk that I'm taking here is about 45 pips. That's it's about 45. Sorry, it's about 485 pips against a profit of about, please, I am in a higher time frame, right? So my risk against a profit about 1,352 pips. This is a very good risk-reward ratio. And I want to play this out for you guys to see whether my trade will activate, right? I am not entering the trade from here. I am going to wait for price to come back, all right? And I'm going to be taking TP, my apologies, and I'm going to be taking TP at this point. I'm going to be taking my TP at this point. I'm going to be taking my TP at those points that I've earlier marked. So I'm going to be taking TPs in 3 areas. I'm going to be taking TPs at 1904, 1865, and 1846. So let's see how the market plays out. We can actually go back to 4 hours to just see how the market, is, playing out. Let's go back to 1 hour. Let me reduce this from 1 hour, or I mean to daily rather, and let's see what happens. This is my daily. Don't forget we are taking our TPs from here. So let's go back to our 4 hours and see how this will play out. I need to reduce this so it doesn't look too large. Then I'll put my TP here, my TP here, my TP here. So you already know that liquidity is residing here. You know that liquidity is residing here, and you know that liquidity is residing here. So you are targeting those liquidity. So the next thing you then want to do is to play this trade out. And let's see, and let's watch out, whether price will definitely take entry. So here we go. Let me make it a bit faster. So price has taken out, so we are in the trade already. TP1 already taken. We are seeing some level of retracement, went back to entry. TP2 now is taking, and now TP3, and we have won the trade. This is simply how to enter a trade and target the area of liquidity, as price moves. Don't forget, I said that price will eventually, come and target this last liquidity. But let's even bring this to today's price, and let's see how much of those liquidity has been taken so far. So let's play. I'm going to make this very faster, and let's just see what happens. So price is definitely going back. It can even take us out, or the previous, entry. So that is why you don't have to be greedy. Every time you get into the market, reanalyze the market, see what the market is painting, determine new entry, and wait for your entry to materialize. One other thing you can also see is that you can even see a higher entry, above your previous entry in the course of analyzing the market every day or every week, depending on what you are looking for in the market. And as you can see, price has gone back to, the previous area that we took our trade from, and has taken all the TPs again from, what we have taken from before. And right now, all we are just trying to do is to bring the market back to this market, and let's see whether all those our levels will be respected. Let's see if all those our levels will be respected. That's one. Let's see how much of the liquidity areas that we have identified up onto this, last area will be taken. And from there, you can now determine what is likely to happen next in the future market, when, in future in the market rather, based on the current price action. So every time you get to the market, you have to look at your current price action, and your current price action should always be the determinant, of where price is going to go next. Don't get into the market and expect that price will just move from your entry to the last liquidity. You might be playing with your money. So guys, let me make this a bit much faster, and let's see how it's going to play out in the market. And you can see price is still playing out, it's playing out, it's playing out, it's playing out. My interest is to allow this market get to current price. As you can see, price even took out the entry point. We enter our first at 1980. Price actually went to as high as 2021, went to as high as 2028, but is still within the TP area. The stop loss area. So for people that are taking swing trade, if you are very sure of a good place to put your stop loss, and you are mindful of the kind of loss size that you are using, and is commensurate to your account balance, you can always take a swing, and you can always win the trade. Now look at this, guys. We actually took this trade from 1980. Our stop loss is above this red line here, which is at 2030. Price never got to our tip, never took us out. But why do you want to be in the market and you wait for so long when you can always take money every day from the market, right? So this is a perfect sell trade. Now, the last thing I want us to see is to actually drag this line to the last, liquidity that was grabbed. And you will see that, guys, just like I said before we started analyzing this trade, this liquidity was grabbed. Sorry, let me just undo this, guys. This liquidity was grabbed, this liquidity was grabbed, and this liquidity was also grabbed. So guys, this is how to simply set up a trade when you have identified a sell trade precisely when you have identified a shift in market structure. Let me go back to my process and just explain to you one more time, what I do when I setting up a sell trade, in any time frame ever. Whatever I've done right now can happen in any time frame. Let me just go through again. Determine the current market structure. Draw your trend line in line with the current market structure. Identify price action and look for shift in market structure. Once you see signs of possible shift in market structure, use your Fibonacci tool to mark the most recent swing low to the most recent swing high in the case of an uptrend, and vice versa in the case of a downtrend. The middle of the Fibonacci, which is 50%, is referred to as equilibrium. Now, above the equilibrium is the premium area, like I said here. This is the premium area, and below it is the discount area, which is this area. Now, the simple rule is to buy from discount. That is, you buy from discount. You buy from discount, guys. You buy from discount from here, and then you sell from premium. To sell from premium. Once you obey this simple rule, and don't forget, I told you that any buy price action that you are seeing in premium is likely to be an inducement, and the smart money might be trying to make you a liquidity for the market. So please watch out whenever you are taking a trade. Now, determine your point of interest, right? So we already know that this is our point of interest. Our point of interest is usually in the discount zone when you are selling. Our point of interest is usually in the discount zone when you are selling. And don't forget, I told you, when you are selling, your point of interest will be the order block, right? That actually created that move to the upside. So this is what I'm saying, guys. That move that actually, this order block was actually the order block. This bullish order block was actually what started, this bullish order block here was actually what started the move to the upside. And remember, I said that I usually like to mark my order block as green, my bullish order block as green, my bullish order block as green. So this is my point of interest. Sorry, I didn't remember to mention that, earlier. Point of interest, POI. That is my point of interest. That is my point of interest. That is my point of interest. Now that I've determined my point of interest, so I know that eventually, at some point in the future, right? At some point in the future, price is going to find a way to reach out for this particular zone, even as the market continues to trend downward. The other area that can be a good point of interest, because if care is not taken, price may actually reverse or do a strong retracement before getting to the point of interest. If you look at this, there seems to be a breakout around this point. If you check this, there is a breakout. This is a breakout. This breakout is actually created a tiny order block here. Let me just mark that place here so that you see. Created a tiny order block here. Created a tiny order block here. Created a tiny order block here. Now, from the eye of the candle that caused that breakout to the low of it, let me remove it. I want to show you a fair value gap. So you can see this is the eye of the first candle, which was broken out. And this is the low. So there is a fair value gap between this black candle and this black candle. Now, if you mark the middle of this, fair value gap, which is the consequent encroachment area, there is a likelihood that as price is coming down now, now, price may never get to this order block before any reversal. It can go back and test from there, but you need to watch out for price action. This is what I'm saying. Price can actually get to this point here, as it's coming down, right? Then get to this consequent encroachment area and then, find its way back up. Or, it can just come here, test this, do this, do this, do this, do this, get to a point here, you look for a reference and still come back to the area. Now, you need to watch out for this. This is remember I said earlier, I usually give preference to fair value gap, that is above an order block, right? And the fair value gap always give me a confidence that the other block that I'm looking at as my point of interest is, is a very valid order point point of interest. So what that is telling me is that even if price does not get there now, at some point in the future, I will still need to keep my highs. Let me just keep my highs on that order block, because it is a point where if you look below, you'll probably see that there is not so much of immediate support. However, there are still some, if you go to higher time frame, there are still some point of interest or area of liquidity that you may also need to pay attention to, because if you look at this look to me like, if you probably go to a higher time frame, maybe like the weekly, you are likely to see that this area is a strong support. And once this area gets broken, definitely, you are almost sure that price is likely to come to this area. Guys, what I have shown you here is the reading of the market. Now, one last thing I would like to say here is that whenever if you cannot get to a point in your trading life where you can do your setup and just walk away from the system, you have not started your trading journey. Allow your trade to play out. Set alarm as triggers to know when your trade has actually activates, and then just let the trade run. Guys, if you enjoy or you understand and you like what I've done here, please do not forget, guys, do not forget to press the like button and subscribe to our YouTube channel so that you can always get notification anytime we share a new video. Take care and God bless. See you in the next video.